Welcome to That's Lit, the Lightbox podcast. We're a venture capital firm based in Mumbai, investing in consumer businesses in India. On this podcast, we're going to be talking about all things consumption, culture, and technology. Our idea is simple. We love to learn. Come learn with us. Together, we'll dig into new ideas, new ways of thinking, and new approaches to solving problems from industry experts across various fields. We hope you enjoy it.
Okay, welcome everyone to another episode of That's Lit. Our guest today is Sanjeev Bikchandani. He is a messiah of India's internet startup. He's the founder and vice chairman of InfoEdge and also the co-founder of Ashoka University. He's recently awarded the Padma Shri in Jan 2020. Sanjeev and I have had the pleasure of knowing each other for about 15 years. And one of the first people I met when I came to India, and one of the first investments we made as well when we came to India, and had a chance to watch and just see how actually not a lot has changed in his demeanor, approach, or anything as he's had extreme amounts of success. And I think that's just amazing to see and something that I'd love to talk more about. But in any case, first, thank you, Sanjeev, for joining us and making the time.
Thanks, Sandeep, for inviting me. It's a pleasure.
Hello and welcome to That's Lit, the Lightbox podcast where we talk about the things that make you go,
So maybe let's just go back to the start. I think that if you go back and look at it, your entrepreneurial journey started even before the internet. And I think the early stories and the things that you had told us and told me a long time ago about working at the Pioneer, having very little money, not even necessarily having the internet as a start. Maybe we can just go back and start with what was the passion that drove you to start something, or where did you think it would go when you decided to get going with something?
Well, so I quit my job in 1990 and I became an entrepreneur. At that time, there was no big idea, there was no vision, there was nothing. It's just, for me, it was a life choice. I didn't want that life. I said, let me try if this life works. So
That life is what? The life of working for someone or the life of...
the life of working in a large multinational corporation as a professional manager and then going up the ranks. I did not want that life. For me, that life was very predictable. It was, so I was sitting in this hall and I knew that if I work well for 3 years, I'll move to that shared cabin. If I work well for 5 years after that, I'll move to that solo cabin. If I work well for 10 years, I'll move to that cabin. And if I work well 15 years, I might become head of marketing, either here or somewhere else. That's fine. That was, if that's what you're chasing, it's a good thing because it was a good company. It had good brands. It paid well. Multinational. The visiting card had Zing. All of that. I began to ask myself some questions when I was about 25 or 26, and some of the answers I came out with was, when I'm 30, 35 years later, when it's time to retire. In those days, retirement age was 58, and people did retire at 58. Although right now I'm 58, but I don't feel like retiring. When I'm 58 or 60, or when I look back on my career, if I continue in a large corporation, what will I have to show for myself? And yeah, I sold a lot of Horlicks, but what else? And I figured that, look, we are prisoners of our visiting cards. We don't want to leave this multinational label. We are prisoners of our EMIs. You bought a car on loan, you bought a house on loan, and then you got to pay off those EMIs. So you want that monthly salary check. You can't leave it. And I figured I should not fall into that trap. And we were measuring success by what I call false proxies. Hey, my car is 1 foot longer than that guy, so I'm smarter than him. I'm doing better than him. And I'm living in this address in Delhi, and Delhi is very address conscious, right? And he's living half a mile away in a DDA flat. I'm living in a first floor of a bungalow at Vasant Vyas, so I must be doing really well, right? And I said, look, I can't spend the rest of my life chasing success, measuring these proxies, using these proxies to measure success. And I figured I got to get out of this, this race. And that's why I decided to quit and do something. And for the first 7 years, I drifted and I did a whole bunch of small things, maybe 10, 15, 20 small things. And I wasn't really chasing money. I was just chasing independence, creativity, and, as long as I could get by, I was okay financially. Right. So in the first 10 years of being an entrepreneur, 7 years drifting, 3 years more bootstrapping Naukri, maybe for 6 years I couldn't take a salary on and off, right? But I was okay. I was quite happy because I was doing, I was independent and I was setting my own priorities and my own goals, and I was happy doing that. So I didn't really want to build a large company. I didn't, we said no to venture capital twice before we finally raised it. And we raised it only because competition raised venture capital. If competition had not raised venture capital, we would never have raised venture capital. In April 2000 from ICICI Venture. And I was actually quite happy running a small, business, a small company out of the second floor of my residence. Life was simple, life was uncomplicated. You were doing decent work and you were breaking even. And I was confident that maybe a year later I'll be taking a salary again. When we finally had to raise venture capital because Jobs I had launched, having raised $7 million prior to launch. And that's when, we said, okay, we've got to raise venture capital. So I was not this crazy, ambitious guy who wanted to build this large company. But once you take venture capital, then you are committing yourself to a certain path.
So Sanjeev, you're going through so many topics. Hang on a second. I've got to ask now. First, 90, you decided to leave a good job. Again, in the 90s, being an entrepreneur wasn't a sought after thing. It wasn't looked upon as what an adventurous guy, what a good thing. We probably had a lot of pushback. How did the family take it? What did they say? What was that view?
So I think I think entrepreneurs need very supportive families in India because there are no other safety nets in India. And in the 90s, early 90s, even more so. And in the early 90s, it was really quite a foolish thing to do. Because see, India has several types of entrepreneurs. There are entrepreneurs by inheritance, that you were born in a business family, you will be an entrepreneur or a businessman at least, right? You're from a certain caste or community, business is a natural sort of option you will go for, being an entrepreneur. You don't have a choice sometimes because you couldn't get a good job. You will try your hand at being an entrepreneur. But India did not have too many educated middle-class entrepreneurs by choice. Where if you're middle class, you've been brought up to work in a job and for a salary, and you've not been brought up to be an entrepreneur. Your entire training and conditioning in India, parents, peers, schools, teachers, everybody, siblings, is study hard, get into a good college, get into a good postgrad, clear the IAS, clear the chartered accountancy, clear the medical exam, clear the engineering entrance, and life will be made. You will get a good job somewhere. So that was the conditioning. And maybe for a number of families, it still remains a conditioning, but things have changed now. But at that time, there were very few successful, educated, middle-class entrepreneurs by choice because, remember, Infosys and HCL had not yet succeeded and become large, right? So there weren't that many role models.
And so when you ventured out, what was the response then at home?
So look, though, at home they were comfortable. I mean, my family has, I think, been very, very supportive. My parents, everybody else at home, very supportive. I got into IIT after class 11, right? And all my friends are going, those who got it, right? And it was a huge aspiration for me as well. And when I went for a medical test at the IIT counseling, I learned for the first time I was partially colorblind. And so I decided not to go to IIT because I felt my career may be impaired, and I continued in class 12 in school. I got into IIT a second time, and I chose to go to St. Stephen's. Now, it was unheard of to choose a BA in Delhi University over an IIT admission. But my parents were very supportive. They didn't question me. I mean, they were obviously alarmed, but they didn't say anything. Right? And likewise, I got into IIM Calcutta straight after college, but I chose to work in advertising in Delhi and then Bombay for 3 years. and then write the MBA entrance again. And once again, they were alarmed because, in India, if you get into IIM, you take it. You just don't think twice. But I wanted to work before my MBA, and I had taken the IIM entrance as a backup. If I don't get a good job, I will, and I get into an IIM, I'll go. So I think my parents took all the bizarre decisions I was taking. My parents didn't intervene, and they said, "Fine, what you know best. You do what you want to do, right? We will support you." So I think entrepreneurs need really supportive families. I think it's really important.
And so now coming back to this, so there you are. You're clearly established. You're a free thinker. You're going about the world the way you want to go about it. But you didn't necessarily have a roadmap or a plan or even somebody to look to and say, look, this is where I'm striving for. So what were
So,
you
I was doing a series of small things, some salaries, some databases, some reports, some small-time consulting, some teaching, some training, some writing. Whatever came my way to make both ends meet, and sometimes not meet, right? But you managed anyway because I was living in my parents' house. And then Naukri was started as one more small idea in a string of small ideas. So the extent of my vision for Naukri when we launched it was, if we can get 500 companies every month to pay 1,000 rupees to list a job on the site for a month, that's 5 lakh rupees revenue. In a year, that's 60 lakhs. The company's revenue the previous year had been 12 lakhs. And, these numbers may seem tiny right now, but they weren't bad for a bootstrap company, a low-cost, frugal operation back in 96, 97, because you could still survive and get by, and you may not be able to take a salary, but the company will survive, right? And I said, if you can get to 60 lakhs a year in 3 years' time, it'll be great going, because then I can take a salary and we'll be profitable. And that was my goal. So it was a nifty small idea among a string of other nifty small ideas that I had experimented with. So it started as an experiment, a small experiment, and it turned out that right place, right time, worked hard, worked smart, got lucky. The internet became big. We managed to raise venture capital, and then you know what happened.
Well, let's talk about that. The idea that, listen, it was not a very well structured projections that's going to take you to 100 crore business, and none of that stuff, which today perhaps a lot of the investing community tries to drive companies to do. Tell me how big your business is going to be. Tell me what your market size is going to be. Tell me how you're going to get to $100 million in revenue. And you didn't have any of those thoughts. You were finding the market as you went along, and you took your time to build it the way you felt was the right thing. Is that better?
Look, I had the luxury of being able to do that because, see, we raised money in a bubble, right? So I remember, we didn't hire a banker, we didn't hire a lawyer because I felt I should save money. It is, quite stupid to not hire a lawyer, but I went and signed and negotiated the SHA and IA on my own using common sense. And whatever knowledge from the law course, the single law course that I had done at IIM Ahmedabad, which wasn't, and I hadn't done too well at that course. But, I found it quite boring. And, so I hadn't paid too much attention in that class. But, I managed to sign investment agreement, which had a couple of clauses which came and bit me, afterwards. But, but by and large, I think barring one or two clauses, I did all right in that agreement. So I had not hired a banker, I had not hired a lawyer, and I had just asked a friend to introduce me to a couple of venture capitalists, and he did. And then I said, introduce me to a banker. And he introduced me to a banker, and that banker was working for ICICI Securities. And I said to him, listen, I'm hiring you only to get me in front of the right people in ICICI, and therefore I will not give you a written mandate. We'll do a handshake. It's a verbal mandate, and I won't give you a retainer. But if I do raise money from ICICI, I will give you something. It'll be less than 2%, but I'll give you something, and we'll agree on it later. Okay, and bubble time, Naukri was a reasonable brand even then. So he agreed, which is unheard of for a banker, that no written mandate, no retainer, no prior agreement on how much he'll earn, no open field, just 2 introductions within ICICI. Okay, he agreed, and he came with me for all the meetings. He worked as hard as he would have normally. Okay, and lo and behold, so I spoke to 4 VCs. We got 2 term sheets written and 1 term sheet verbal. So 3 out of 4, we got term sheets. But that is the magic of trying to raise money when people really want to give it to you. Right?
Yeah.
We had been very conservative in our projections because we thought we were truthful. So we were doing 3 lakhs a month of revenue. And that's about 36 lakhs a year. And we had projected that 4 years out, we'll do 1 crore a month, we'll do 12 crores a year. And it was quite silly, actually. ICICI asked me, what valuation do you want? Are you looking for? So I said $10 million. And they said, why $10 million? So I said, because that's the valuation you gave Nirmal Jain of India Infoline, and he was in my dorm. And there is no way I can, I can lose face and have a lower valuation than him. Okay. Now that must be the most bizarre logic for a valuation, but that's what I said. Having said that,
in our world today, that may be as sound a logic as the logic you hear for other series is. So.
Yeah, it was emotional. I said, listen, I will lose face if I. What will I tell my dorm mates? That I got a lower valuation than Nirmal Jain? Okay, so that's the benchmark for me, right? Fortunately for me, I had got another term sheet, another venture capitalist at 15% higher than 10 million already. So ICICI told me, hey, listen, we can't give you this valuation because you're projecting only 12 crores a year. How can we give this valuation on a 12 crore a year top line? So I said, listen, that's the valuation I want, and I've got this other term sheet. So, decide. And what the Amit Beheldi, who's now working with us in InfoEdge Ventures, or he was then at ICICI Venture, he in his internal note, he wrote that, listen, this is what the company is saying. We believe that it'll be much higher than, and therefore we are recommending this valuation is okay. And that's the only valuation we can get the deal at because they got another term sheet. And so on the basis of the internal projections and not our projections, they gave us that valuation. Now, on the day I was signing the SHA and the IA, right, the CEO of ICICI Venture, then Jay Chanda, he told me, Sanjeev, can you do something about your projections? Because no, it's really, we are giving this valuation on our projections, not yours. So I said, no, these projections are truthful. But all the others are giving such much higher projections, all the others we are funding. I said, they're all lying. Because spreadsheets right now are fiction. You can write what you want. This is what we believe in. And I insisted. Anyway, we went ahead and signed. But that was actually a really good decision on our part because the market melted down within 15 days. The bubble burst. So .com melted down, then IT and telecom went into a bust after Y2K. Then 9/11 happened. So, within 6 months, we probably had 90% value erosion, during that bust. And, if you look back on those days, Sandeep, you know what I'm talking about, right?
Yeah.
And so we had very nervous investors sitting on our board with crazy sort of SHA giving disproportionate powers, but we had given very low projections. Now this fund had invested in 32 .coms, right? Of the 32 .coms, you were the only one exceeding our projections.
Were you exceeding their projections as well, or?
No. This is what they told me. This is what Amit Bell told me. He said, boss, you are all right because when the audit happens every quarter, you are exceeding your numbers because you had lowballed so much, right? And therefore nobody can touch you. Right? Of the remaining 31 .coms, I think 25 or 26 were simply shut down because they refused to get the balance tranches. They took back the money that was in the bank. All those things happened.
Yeah.
Right? And we survived and we did well. And, they gave us time because we were exceeding our projections. And we returned the fund.
Yeah, well, you did more than that, I'm sure.
We gave 28.5x in 6.5 years. It was pretty good, which is a record for a long time.
Well, until now, you've set some new records as well, which we'll come to. But remember, I remember you telling me the story of the investor who talked to you about a vision problem.
Yeah, that was a different era. So I met, so see, we were being chased by investors, and we kept saying, no, I don't want to raise money because I'm very happy running a small company. I don't want to complicate my life. I don't want to sign a fat agreement with all sorts of clauses. I don't want to be accountable. I will not give an MIS. I will not be told what to do, right? And I'm happy because I'm going to make a profit next year. So this around mid '99. So there's a whole bunch of guys, coming down to meet companies and they're almost all were based in the US, and we were just flying down and just meeting companies and trying to scout and invest and go back to New York or Bay Area or wherever they came from. And I remember this guy telling me, so why do you think an investor should invest in your company? Now, I'm not looking for money, but I do believe I'm worth backing. So that's ego, right?
Yeah.
So I proudly told him, well, it's because I'm making a profit. So he says, if you're making a profit in the internet industry today, it means you have a vision problem. You're not supposed to make a profit. You're supposed to scale, make big losses, and increase valuation, and you don't make a profit. You've got a vision problem. So you're thinking too small. And this is a problem with you Indian entrepreneurs. You want to make a profit. This is a new economy. This is around July '99, right? The meltdown is still 6-9 months away, right? And I'm baffled, because all my life, nobody ever called me up to give me money and discuss investing, and nobody, and breaking even was something I was proud of, because you have to do it with your own money, customer money, operating revenues always till then,
Yeah.
and I couldn't do that math, right? And
But
I told him, listen, I worked in advertising. If you spend this money on advertising, you're never going to get it back. I know advertising. I worked there. So he says, hey, you don't want the money back. You just want to build valuation.
mm,
Okay. I
refreshing
said,
how
yeah.
direct he was, huh? At least.
Well, that was the lingo then. They were valuing eyeballs, and they were, I was completely baffled by this approach. And I said, you know what? I don't think I can do this. So no matter, it was tempting, right? I don't think I can do this. And I wrote back saying, thank you so much, but we'd rather remain a small company running out of my dad's house, and we'll grow slowly, and we should make a profit next year, and we'll be fine, right? And that's what we said in July '99. And then Jobs had launched in Feb 2000, having raised $7 million from Chris Capital.
Mm.
And they launched with a TV ad campaign on the India-Pakistan cricket series in Sharjah. And the budget for the launch ad campaign was 2x of our annual revenue. They spent 75 lakhs in that launch, and our annual revenue was 36 lakhs.
Wow.
And so we died of fright. And we said, it looks like we'll have to raise venture capital. You can't be a 50 lakh company, 60 lakh company a year revenue company with 10 lakh profit. You got to be a 5 crore company within 2 years and make a 50 lakh profit. But to get from orbit A to orbit B, you will have to lose money for 2 years, which means you have to raise venture capital. So we went back into the market, and finally we decided that we will go with ICICI Venture, even though that valuation is 15% lower, right, or 10% lower, simply because this is an Indian VC.
Yeah. But let's talk about, you lived through a very difficult start. You opted to go at a different pace. Today, you funded companies where, again, I clearly youth is not an issue for you. You're willing to fund young people. It sounds, you were young when you started, so you don't have any concern with that. But these companies are not necessarily having to struggle as much. Some of them are, I guess, have adequate vision with the capital that they're burning, and therefore are seeing the bigger picture. How do you get comfort with that? How do you reconcile that? Because it fights against the grain of who you are, right?
So listen, if you look at our anti list, right, companies we said no to, several of them have gone on to be highly, highly successful. So I said no to Flipkart in their pre-series A without meeting them. I just said no to somebody who sent me a PowerPoint and told me about the company. I said no to Ola in the pre-series A after meeting Bhavesh. I said no to Taxi for sure the pre-series A after meeting them. I said no to Snapdeal twice at 28 million. I said no to Big Basket. I said no to Lenskart. I said no. I said no to so many companies, right? And the reason why I said no, or we said no, is because I could not figure out how they would make money, right? Now, but if we had invested, even if the company not making, we would have made money, a lot of money. So in hindsight, perhaps they were wrong calls, right? But in all the companies we invested in, we knew how they could make money. Of course, none of them made money yet. Okay, which is the irony. But at least I could imagine and fathom how they could make money.
But again, look, I go through this all the time as well. We look at the projections that we put together in our investment memo, whether companies are our own. We look at the plan we've laid out for the businesses. We feel very good about why they're going to do a certain set of things and where we believe it'll go. And none of them follow that path. They all follow a different path, some better, some worse, but they get somewhere else. So how much value is worth placing in that initial assessment of, I don't know, there's a projection. You could see how it might make money. You could see how it may not ever make money also. Do you really, have you found that there's
I can see how this business would make money if I was running it. Okay. Now, the guys may or may not run it that way. The other investors may come in, the environment may change, there may be competition, there may be truckloads of capital coming in, which has happened. And therefore, everything changes. Right? But at the time of going in, I can imagine how they'd make money. And for us, that is an important test even today. Can
and
this
so,
thing make money?
So you've got the imagination
Not as
how
an
you
investor,
might do
but
it.
as an operating business.
Right. So you've got that thought. You believe that there's an opportunity. Now you step into this world, and actually in the current context right now of a hiring world where BMWs and trips are being given out to engineers to join companies and all sorts of crazy things are happening. How do you look at that and say, listen, the way you've seen building a business and the way you built a very successful business has been by slogging it out, understanding the market, being there, not taking advantage, not taking other people's money and going nuts with it. Yet it seems like the world has shifted in that context here. Do you think that that's good, bad? Do you think it's going to be problematic?
Well, it's, I guess, neither good nor bad. It's real, it's happening. And you got to live with that, right? And within this sort of changed environment, companies have to figure out how to survive, how to grow, how to compete, and how to win, right? And sometimes it may mean you raise a truckload of money, as Zomato had to do, because competing with Swiggy, which had got Naspers behind it and a whole bunch of deep pockets behind it, and it had become a kind of arms race in terms of who will raise more money and who will then give more discounts to get a higher share. To some extent, these were signals given by the investing environment, where you were being valued on number of transactions as opposed to unit economics for a while, right? But when the market shifted, Zomato adapted. So the sign of a good entrepreneur is that he will do what it takes, but he can switch back to a better unit economics and profit whenever he wishes. So quite honestly, I personally don't have the courage and the risk-taking ability of some of the younger entrepreneurs today. They think bigger. When I look at Dipinder at 28 and I compare him to what I was at 28, he is so much smarter.
Well, he's also got the benefit of your experiences to help give him perspective.
Yeah, here's the thing. Truly great entrepreneurs don't listen. They'll have a conversation, but then they will do what they think is right. Not so great entrepreneurs also will not listen. They'll do what I think is right, but very often that'll be a wrong thing. Right? But Dipinder, for example, Yashish, for example, these founding teams, they march to the beat of their own drummers. So, as investors, we like to think, hey, we built this company. No, we did not build the company. The entrepreneur, the management teams, they built the company. So if you invest behind a team that needs more than 2% handholding, you got the wrong investment. The secret of successful early stage investing, according to me, is to invest behind companies who will succeed anyway, with you or without you, right? So, I mean, Deepinder Goyal, Zomato would have succeeded anyway. Policy would have succeeded anyway. Yeah, we gave them money, and perhaps at that stage we were the only ones giving them that kind of money, and that helped. But they knew what they were doing.
Yeah, well, I guess you also have the approach, like you pointed out with ICICI, with you guys, of being willing to let them make the mistakes or make the moves that they need to make. So today you have a good balance sheet. You have the capacity to fund at the highest levels here, but yet you stay focused on early stage. You stay focused on building businesses from the start. Is there a reason? Do you not feel like you want to? You mentioned
It's what I know. Number one. So, I will stick to what I know and understand. Number one. Number two is, you see, when you go early stage, you risk less capital, at least in the first check. I'm a risk-averse guy. I'm a bit of a coward. In Hindi, I would say I'm a darpok. So here's the other thing. I think successful investors in the long run and successful entrepreneurs in the long run are not just good at identifying return. They're also good at measuring and managing risk. And we don't understand that in boom times, but we really understand that when the market melts down.
So,
right?
Yeah.
And if Zomato, if we have been successful in Zomato today as an investor, it's a lot of it is patience. We went in 2010. It's 2021. We are still in there. So here's the other thing I want to mention, Sandeep, since you're running a VC fund. So the VC model, to my mind, and the speed at which the Indian market will allow companies to grow and then go public and give exits, right? There's a mismatch. Because VC money is 8 plus 2 years money, 9 plus 2 years, at best 10 plus 2 years, right? But from inception to IPO, typically a company in India will take 10 years, 12 years, 15 years. I mean, take a look at Matrimony, it took 20 years. Yeah. Take a look at Naukri, it took 10 years and we were fast, 9 years. We were the fastest. And we were 6 years, 6.5 years from our Series A. That is really fast. I think Make My Trip took 10 years. I think Just Dial took 17, 18 years. I think IndiaMart took 20 years, right? It takes a long time. Now the truth is, if you leave out Flipkart, strategic sales in India haven't given the kind of value to VC investors that will help them return the fund and more.
Yep.
Unlike the US. So essentially, you're talking about taking the company to IPO, right? If you want a wild return, which basically means you need really patient capital. Actually, Sandeep, what you need is a 14, 16-year fund.
Yep.
But I don't know if you go out in the market, Sandeep, Lightbox next fund. Yeah, I want a 14-year fund, 16-year fund, whether you'll get the money you're looking for. So look at it this way. We went into Policybazaar in 2008, right? It's 2021, 13 years. If I'd running a fund with a life of 10 years, I'd be nervous about an exit maybe in 2014, 2015.
Yeah.
Right? But the bulk of the return has come in the last 3 years.
Yep.
After life of fund. What life of fund might have been. So I think somewhere you guys the VC industry in India needs to put their heads together and say, listen, guys, how on earth do we convince our LPs to give us longer term money than they are used to in the US market?
Well, let's look at it differently. Maybe also what should emerge here, and hopefully will, you'll see companies now start to acquire a little bit more. M&A will evolve. Hopefully, someone like Zomato uses this currency, someone like Policybazaar uses this currency, is willing to aggregate. It looks like they're taking stakes, right? I mean, actually, that was another thought I had. And how do you feel about this? A lot of companies that aren't profitable are raising large sums of money, and whether privately or publicly, and subsequently investing. Well, first, as a company, they're investing in other ideas. But even as founders, you're finding that founders of companies are some of the most prolific angel investors in the market.
So look, I think 2 or 3 great pieces of advice and directives I was given by various people around the time we were raising our Series A, right? So one piece of advice, after ICICI invested, number one, it's not your company alone anymore. It's also our company. So you can't run it the way you were running it. you have to look after minority shareholders. Just as we are equal owners, even though our percentage is lower, right? Number two, we are betting our money, you're betting your life. Now, the asymmetry is that an investor has a portfolio where they divide the money, but the entrepreneur has only one life. That's asymmetry. But that's the way it is, right? We are betting our money, you're betting your life. So don't even think of leaving and quitting and going away. If the company goes down, you go down with it, right? Number three, and then he went on that vein and he said, and therefore, you don't get rich till we get rich. Our interests have to align, which means you can't sell any shares and we decide your salary. You can't get rich on our money. Okay? And you can't get rich before we get rich. Okay, and he said these things must be hard-coded in your head. And the fourth thing he said is you got to make yourself dispensable, which means build a second line of management, third line of management, because if you get hit by a bus, our money should be safe anyway. Right?
What a warm conversation to have had, huh?
It was frank, it was candid, and I was so grateful to have got the money that I said yes to everything. Right? So that's been a guiding principle.
Yep. Listen, I want to change topics for a second and talk about education. So, what sparked Ashoka? Maybe we take a step back and just explain. I know Ashoka. I've been watching it for many years. What was the vision? Where are you going? Why did you do this?
We were trying to solve a few unsolved problems. So, number one unsolved problem was that, look, we have inherited the British education system, which means you pick your subject and just study that subject in college. Right? The US education system is that you study a diverse range of subjects and then decide your major. So you have a better idea what you want to major in. More importantly, you're able to join the dots across disciplines, because life is multidisciplinary. It is not a single discipline. Right? And we felt that was perhaps a better way to go. But there was no college in India which offered diversity. Compulsory diverse course mix before you decide your major. Number one. Number two is, the truth is that, look, in India, your major is decided by the marks you get in your class 12 boards or your rank in the engineering entrance exam. Now, you may be dying to be a computer scientist, but you got to study civil engineering because that was your rank. Right? Which I think is really silly.
Yep.
Some bureaucrat in Delhi has decided that there will be 40 civil engineering seats here and only 15 computer science. The market is giving a signal there should be 400 in computer science and maybe 20 in civil engineering. Right?
Yep.
So we said, listen, people should enter the college and they can change their majors, which is what they do at Ashoka. The third thing, was that, look, in India, in the Indian middle class, there's this massive quest for financial security. And therefore, people are pushed into studying some things in college which they don't really passionate about. Because at the end of it, they believe there's a good job. Right? And and willingly that becomes engineering.
Yeah.
So you have this whole army of people studying engineering. Maybe 40 or 50% don't actually want to study it. They've been pushed into it. But if you can, if you can create an institution where people are studying stuff that they want to study because they're passionate about it, and at the same time, you have a good placement effort where people get jobs, then suddenly it's a viable alternative. This is the way to do it. And I got this message. You see, if you go to any Indian venture capitalist, investor, investment bank, consulting company, anybody in India, you will find a bunch of guys who are IIT and IIM. Nobody outside the mold. But as I began to go to the US and London, and other financial centers on investor meetings after he listed. I used to ask people, so what did you study in college? And I found there were actually so few MBAs among the Americans. So I met this guy. He says, "Oh, I studied economics and political science in college." I said, "Really? And you did an MBA from?" "Oh, I don't run an MBA. In fact, our hedge fund does not hire MBAs because they believe that MBAs have to unlearn so many things because they come in with already formed ideas of what the right thing, right way to analyze a business is or a balance sheet is. So we train our own people and we teach them in our methods. And I discovered so many people, some of the smartest people, some of the smartest investors were not engineers and they were not MBAs. And I said, you know what? I think maybe the time has come to try something like this in India, where people who are outside the mold, who are outside the cookie cutter, can actually achieve stuff and surprise people. And so Ashoka was. Then there was this whole thing of we do collective philanthropy, and there was this whole thing of a private sector, a private sort of liberal arts thing. Lots of private engineering colleges, lots of private medical schools, but there's no private liberal arts college. So there was 7 or 8 things we were trying to do. So Ashoka is a sort of an outcome of these 7, 8, 9, 10 goals, objectives, desires.
And you feel like I mean, from everything I've seen, it's off running. Traction seems solid.
Yeah. So I think we have sort of achieved stuff faster than we hoped before we launched. Of course, it's still a work in progress. It's still an experiment. It's still a project. It's not done yet. May not get done for the next 50 years because it'll keep evolving. But yeah, I think it's off to a good start.
And so in this world, and it's kind of hard to today talk about education and not talk about another side of it, which is what we see happening with the valuation of a Byju's, for example, and that approach to it. And and actually, in general, if you think about education and healthcare, these are things that should ideally be made available to lots of people. It's necessary to improve the country overall. Today, you're looking at a company that's, okay, let's say 30, 40, 50 billion in value, built off of some aspect of providing some of this stuff. Do you think it's a good outcome in the context of education to see that happen?
It's a good outcome because it will incentivize so many people to try. And people try different models. And ultimately, somebody will try a freemium model or a free model, which is monetizing somehow or the other differently. So, for example, there's nobody who's yet that big in vernacular to the best of my knowledge. But really, India lives in vernacular, in regional languages. I mean, that's what most students study in school.
Yep.
So there's lots of unfinished work in the tech space. And not all of it will get a Byju valuation. But because Byju is there, it attracts so many other people to try that enough people do it differently, and some of them will get it right as well.
So now, InfoEdge Ventures, you've now set this up as a separate entity. This is different from the company. Is there any other structural or philosophical difference now that runs InfoEdge Ventures from what you were doing before?
Well, there is. So it's a fund now, which means it's got a finite life, unlike earlier. But we've kept it 12 plus 2 years. This is 14 years, which we believe is long enough. So it's atypical in that sense. Number one. Number two is it's only got 2 LPs, InfoEdge and Temasek. Both these LPs have a long-term view in India. Both these LPs, are sort of permanent capital. So we believe we can work like a fund, attract talent like a fund, compensate like a fund, have the rigor and discipline of a fund. At the same time, we have the luxury of being patient. Because India demands patient capital. It doesn't give you exits faster than that.
So does this mean you're further removed now from Naukri and the operating businesses? And
I have not been, the operating business has not been reporting me for 10 years now. Hitesh looks after them. But of course, I'm on the board and I sit in the same office and we talk and all that happens. And that's fine. That's the way it should be.
So as you now think about new investments, is there something that you're interested in solving in the world? The problems that you want to solve? Is there something you're hoping somebody fixes?
Well, what I've learned over the last 10, 13 years of investing, uh, you know, that it's a bad idea to do top down. Hey, we are in 4 classified categories. We are not done automobiles, let's do automobiles. And you go and invest in the number 5 automobile site, right? Because you do early stage. You'll guarantee to lose.
Mm-hmm.
As far as we are concerned, the auto classified ship has sailed unless you do a late stage acquisition. And we're okay to live with that. We prefer to do it bottom up. Just meet 1,000 startups, and figure out which ones you want to back. I mean, if we had gone in top down saying, hey, which sector should we look at? We would never have found a Zomato. We would never have found a Policy Bazaar, because we would never have even imagined that we should look in that area.
Yeah.
So according to us, bottom up is best. See what's bubbling up from under.
So
And
let me ask you a different type of question. What do you think was your biggest mistake over the course of this career?
I think we made many mistakes, yeah. The one is the ones you said no to, but forget those. Among the ones you said yes to, in some cases you misjudged the entrepreneur. In some cases we misjudged the competition. In some cases we misjudged the capital consumptiveness of the business. In some cases we misjudged any changes or lack of them in the regulatory environment. But look, if you get 1 or 2 right and you get them right big, all sins are forgiven. Right? And that's the nature of the VC business, yeah.
And that is why right now the market is hot, and now is the time to recognize some of that value, get those things right, and continue to play the game. And I think that's the reality of our life right now, and the focus of it is to make sure the things that we've been building for the last 8 years in our second fund are starting to see some value, and hopefully the markets stick so we can get there as well. Excellent. Sanjeev, listen, thank you so much for doing this. I'm always just in awe of listening to the stories and just the journey that you've gone through. And I think it tells a lot to the culture you've built at InfoEdge. And I hope the culture that you impart as well to a lot of the companies that you invest in. And I think that if people can take some of those values and carry them forward, I know I try to, and I've tremendously enjoyed the years that we've spent together, and I've tried to imbibe that in some of the ways.
I'd like to say a couple of things. So one is for the listeners, I don't know if you know, but Sandeep was on the board of InfoEdge for a few years when Kleiner Perkins and Sherparo were shareholders, and he was representing both of them. And, I'll tell you one last thing, Sandeep, which Ram said, Ram Shri Ram of Sherparo, and he was a shareholder in our company. And he once said, Sanjeev, just remember, in the final analysis, your reputation is your only asset. Everything else is built on that. And I'd urge all listeners, whether investors or entrepreneurs, to remember that. These are golden words from Ram Shri Ram, which I have kept with me.